Good morning, everybody. Good morning and welcome to the Central Bank, to our 16th floor conference room, and specifically to the 2015 Financial Stability Report presentation. I would just like to acknowledge members of the Central Bank Board of Directors, the Deputy Governor of the Central Bank. I will acknowledge the head table shortly. The CEOs of the banks and insurance companies. I noticed James Camacho here, President of ATIC. Welcome. Any other representatives here from the Chamber of Commerce, members of the media, members of staff, and of course, the public who would be viewing us now through our live stream. We're really happy that you took time to come to see us this morning and to meet with us this morning, and we promise you it will be worth your while. To just acknowledge the members of the head table, well, you know Governor Dr. Alvin Hilaire. Seated next to him is Mrs. Michelle Chung-Tai-Bell. She's our Inspector of Financial Institutions acting. And next to her is Mrs. Michelle Francis Panto, Deputy Inspector, Banks, Non-Banks, and Payment Systems Oversight. And they will be the ones who will do this morning's presentation. So please welcome Michelle, the first Michelle Chung-Tai-Bell, to the podium. Warmly welcome her to the podium where she will walk through the presentation.
Good morning, ladies and gentlemen. It is my pleasure to share with you the findings and insights based on the work we've been doing in the financial stability arena. It's certainly not a coincidence that, like many other central banks and financial regulators worldwide, our interest in financial stability has grown since the 2008-2009 financial crisis. The first financial stability report was released post-February 2009, based on September 2008 data. So the bank has been doing this for 9 years. Many things are different, but many things are the same. But we've learned a lot, and hopefully the report that we share with you today will give you a better appreciation of the work we've been doing and how we see the landscape, and will provide more insight into what is driving the way we supervise the sector and what's behind some of our strategic priorities on the research and regulatory front. My role today is to give you the highlights of the first few chapters of the report dealing with the performance and potential vulnerabilities in the domestic financial system. Then the Deputy Inspector, Mrs. Michelle Francis Panto, will follow with an update on de-risking, FATCA, and AML-CFT issues. And the Governor, he'll close, and he'll be dealing with the insurance legislation and payment systems, and he'll wrap up by reiterating some of the key points we'd like you to come away with today. Of course, all of this is being said against the backdrop of the terms of trade shock and the current economic environment we discussed at the launch of the May Monetary Policy Report a few weeks ago in this very room. So the context of this new normal, so to speak, in that context, let us first look at our financial system. By developing country standards, the Trinidad and Tobago financial sector is relatively large and diversified, accounting for approximately 13% of GDP. The sector is made up of 8 commercial banks, 16 non-bank financial institutions, 34 operating insurance companies, 10 life and 17 general insurance, and 7 composites, 129 active credit unions, 189 active private occupational pension plans. And then the other large players, of course, would be the Unit Trust and the National Insurance Board. Commercial banks still dominate, with a combined asset base of $145 billion, and they account for 44% of financial system assets. Together, insurance companies and pension funds make up more than 30% of the system's assets. Right. The central bank tracks the performance of the banking and insurance sectors using a suite of financial soundness indicators developed by the IMF, and over the years we've adapted some of these metrics ourselves. Now, these metrics are a tool within our analytical framework that is used to assess strengths and vulnerabilities of sectors within our financial system. Some of these can be considered to be leading indicators, and others allow us to assess the current balance sheet strength, liquidity, and profitability of these institutions. These indicators include measures of capital adequacy, asset quality, earnings and profitability, liquidity, and market risk. What we are seeing so far is that challenges within the domestic macroeconomic environment stemming from the fall in energy prices has not yet translated into any material decline in the key financial soundness indicators of the banking and insurance sectors. Overall, in the banking sector, regulatory capital to risk-weighted assets as of December 31st, 2015 was 24%. Liquid assets to total assets at 23.1%. And all banks, in fact, all banks and non-banks reported capital adequacy ratios above the minimum of 8%, and most banks' capital ratios are in excess of 20%. These ratios are computed based on the international Basel I capital adequacy standard, which focuses on credit risk and market risk. I'd just like to take the opportunity to mention an important project for the bank, which is the rollout of an updated risk-based capital adequacy framework modeled on the Basel II standard with some elements of Basel III. In 1988, the Basel Committee on Banking Supervision published a set of recommended minimum capital requirements for banks known as Basel I. One of the aims of the committee is to align global banking supervisory requirements. Trinidad is still on the Basel I standard, so the capital adequacy ratio that I just described is on the Basel I standard. Under the Basel II framework, the approach to credit risk has been refined, and a bank will also be required to hold minimum capital for operational risk. The new framework improves risk sensitivity of banks' capital requirements. The higher the risk, the more capital that will be required. And this will therefore improve banks' capacity to withstand adverse events should risk crystallize. And the central bank has launched a quantitative impact study to assess the adequacy of each bank's capital on this new standard. Now, as you can see from the chart, asset quality as measured by non-performing loans to gross loans in the banking sector has been steadily improving, having fallen from 6.2% at the end of 2011 to 3.7% at the end of 2015. Some other indicators of credit risk would be credit card delinquency. There's been no major spike that we've detected in credit card delinquency, but early delinquency is being closely monitored to determine whether there are any emerging issues. Banks, of course, are also monitoring what they consider to be their more vulnerable accounts. So that would be facilities extended to persons, for example, employed in the energy sector and related industries. And given the environment, the central bank is engaging with banks with a focus on monitoring and assessing the credit quality of loan portfolios. The banking sector recorded healthy profits for the 4 quarters ending December 31st, 2015. Return on equity increased from 13.5% in 2014 to 18.2% in 2015. Return on assets increased from 2.1% to 2.5%. As you can see from the chart, the increase was driven by increases in dividends from subsidiaries and affiliates, an increase in foreign exchange profits, an increase in income from spreads, which would be net interest income less interest expense, reduced operating expenses, and an increase in fee income. Income from spreads as a percentage of total deposits and other interest-bearing liabilities in 2015 was 4.1%. So the banks have been profitable, and retained earnings strengthen their balance sheets, and that adds resilience to our sector. On the insurance side, the total assets of life insurers totaled $21.6 billion at the end of 2015, excluding CLICO and British American. 2 regional market players account for 66% share of the life insurance market. Now, the metrics on the insurance side is not as comprehensive as on the banking side. However, these financial stability indicators also point to stability within the life and non-life sectors. In the life insurance sector, the ratio of capital to total assets has exceeded 20% over the past 5 years. The impact of the low interest environment on life insurers is recognized through the balance sheet increases in actuarial liabilities. Those increases impacted profitability in 2014. The return on equity fell from 15% in 2013 to 10% in 2014. However, profitability improved in 2015, with return on equity increasing to 11.2%. Government securities continue to be the largest proportion of assets, representing 40% of insurers' asset portfolios, and it's the second largest asset class is quoted equities, and then mortgages, which insurers have gone into in the last few years in a bigger way, consequent upon the low interest environment. Mortgages are now the third largest asset class. Non-life insurers were similarly impacted by the low interest environment. Investment income as a percentage of net premium reduced from 8.8% in 2011 to 5.8% in 2015. Profitability as measured by return on assets and return on equity has been volatile over the past 5 years, but this is not unexpected given the nature of short-term general insurance business. Now, because of our heavy dependence on energy prices, we in Trinidad and Tobago are all too aware of how one event or the confluence of many events outside of our control can have a profound impact on our lives. Our financial stability work is done in the context, therefore, of the global macroeconomic environment. Many of the issues Michelle will speak to in a little while are not our issues alone. Many of the solutions require close collaboration with regional partners, and things that impact them will certainly impact us. So what are we seeing out there? Well, the global economy remains in a low-growth cycle. In the region, tourism-dependent economies outperform commodity exporters such as Trinidad and Tobago and Suriname. In some Caribbean countries, public debt levels continue to trend upward, even in the commodity exporters, increasing the risk of further sovereign debt restructuring. And there are concerns over the loss of corresponding banking relationships. So that, in a nutshell, is the global backdrop for our assessment of potential vulnerabilities and risk. Now, while the financial sector appears stable and healthy, macroeconomic reversals caused by the severe drop in earnings from the country's main exports present new challenges. Deteriorating conditions manifested by rising unemployment and imbalances in the foreign exchange market are a few of the emerging issues confronting the country. Against this backdrop, Chapter 2 of the 2015 Financial Stability Report assesses the vulnerabilities and risks posed by macro-financial developments to the Trinidad and Tobago financial system. I will not go through all the risks covered in Chapter 2, but I'll just give you a flavor for the thinking behind the assessment of vulnerabilities and the financial stability implications of a scenario of household financial stress and correction in house prices. First of all, keep in mind that loans to consumers and business have been around 38% of banks' balance sheets for some time now. The business sector showed little growth in 2015. Loans to the business sector grew by 1.4%, whereas growth in 2014 was 6.1%. And mortgages represent the bank's largest exposure to consumers, accounting for 18% of gross loans. Also remember that insurers have increased their weighting of mortgages. And consumer growth has been strong over the past 3 years or so, especially strong over the last 3 years or so, led by motor vehicle loans and real estate lending. So what are some of the vulnerabilities given these trends that we have seen? What are the factors that have the potential to increase pressure on the repayment capacity of households and increase credit risk in the financial system? That would be low business confidence impacts demand for credit. An increase in interest rates will affect repayments on variable rate loans. A negative shock to income associated with a rise in unemployment will also increase pressure on the repayment, of course, capacity of households. and a decrease in property prices impacts the bank's collateral and credit risk. So what do we see as some of the mitigating factors in this environment? Well, the quality of mortgage underwriting by commercial banks has always been quite robust and conservative. And this has been borne out to date by the favorable non-performing loan ratios of mortgages, which has been within the ratio area of 1.7% since 2010. The other mitigating factor would be the level of capital and profitability of the sector. Also, our financial supervision team intends, as I said, to engage with banks to monitor and assess further the quality of these loan portfolios and how things, and keep on monitoring how things evolve in the environment. Our research teams are focusing on household debt, interrogating the house prices, and in this regard, we've included as an appendix to the report some preliminary work on household debt. This investigation utilizes currently captured forms of household debt data to highlight the vulnerabilities in the domestic financial system. It also introduces the central bank's ongoing initiative to strengthen understanding of risk posed by indebtedness in the household sector. So we've identified the vulnerability, we've assessed mitigating factors. How have we tested the impact? The central bank's property price stress test has been used to test the impact of capital of a shock to property prices. The results of the test indicate a resilient banking sector which is capable of absorbing potential losses in the event of financial instability. Going forward, we intend to continue to refine these stress tests to ensure that they're relevant, reliable, and capture all of the plausible risks facing the financial sector. The Financial Stability Report gives a point-in-time view of dynamic risks and vulnerabilities within an interconnected system. Further, as the financial system evolves, new vulnerabilities will emerge. However, vulnerabilities that may appear worrisome need to be assessed against the resilience of our financial institutions and the financial system. The banking sector's financial stability indicators of credit, market, and liquidity risks appear contained, and the insurance sectors have been stable. So we believe that our system is resilient, and at this point we have no major financial stability concerns. And it is, however, important to remember that this is an ongoing process. The world is changing every day. Our research department is constantly scanning the environment. Every day we get these financial stability bulletins in our inbox. In fact, in the last few days, I've been worried that something crops up that changes the perspectives in this report that we hadn't even launched as yet. But then I remember that this type of assessment is not intended to be a prediction of a future path. The purpose of this work is to assess downside risks, raise awareness of key vulnerabilities, and craft policies and promote actions that mitigate these vulnerabilities. And these actions will reduce the impact of when or should the risk materialize, or reduce the likelihood that the risk will materialize. And so these actions are intended to increase resilience of our sector. So financial stability monitoring and risk assessment is for us not an end in itself. Our financial system is evolving, and not only must we be alert to any new vulnerabilities that will emerge as a result, but by our supervision and actions, we must promote the resilience and mitigate risks within our banks, insurers, pension plans, and payment systems. And with that, I will now pass you on to Michelle and the Governor, who will tell you more about some of these actions and certain areas of focus for us.
Good morning, everyone. The de-risking phenomenon is an emerging global trend and is defined as the practice of financial institutions either terminating or restricting business relationships with clients or categories of clients considered as high risk in order to avoid rather than manage risk. Globally, there is an observed trend of de-risking of money service businesses, non-profit organizations, and correspondent banking relationships. Correspondent banking refers to the provision of banking services by one bank, the correspondent bank, to another bank, the respondent bank. Correspondent banking relationships facilitate access to international trade and payment systems through the provision of accounts, clearing-related services, and wire transfers. In a 2015 World Bank survey entitled Withdrawal from Correspondent Banking, Where, Why, and What to Do About It, 75% of the international banks surveyed indicated that they have reduced the number of accounts held on behalf of a foreign respondent bank between the end of 2012 and mid-2015. The majority of international banks surveyed also indicated that termination or cutting back of their correspondent banking relationships with certain jurisdictions is part of wider policy changes in relation to broader risk management. Why are banks de-risking? De-risking can be the result of several drivers, which can be put into two main categories: either business or economic reasons, or risk reasons. However, both reasons are interrelated and pertain to the higher cost of complying with international standards such as Basel II, anti-money laundering and compliance of combating of terrorism financing, FATCA, and other taxation standards. Non-compliance with these global standards is accompanied by the risk of de-risking, blacklisting, and the incurrence of other sanctions or punitive fines. Whatever the rationale governing the correspondent bank's change of policy, the effects are felt globally. Of the 170 local or regional banks that participated in the World Bank survey, in the regions that are most affected by declining foreign correspondent banking relationships included Europe and Central Asia, where over 80% indicated a moderate or significant decline in their correspondent banking relationships. Closer to home, in the Latin American and Caribbean region, it was highlighted as a region significantly affected by declining correspondent banking relationships. For many, the reasons given cited concerns regarding AML-CFT regulations and customer due diligence and know your customer obligations. In several Caribbean territories, commercial banking transactions, international business companies, local charities, or money service businesses have been de-risked. To date, Trinidad and Tobago's financial institutions have not been as impacted by the loss of correspondent banking relationships. Some local financial institutions have indicated, however, that there is greater scrutiny from their correspondent banks with increased queries regarding customer transactions and beneficial ownership. It should be noted, however, that locally, some sectors considered as high risk for money laundering or terrorism financing, for example, private members' clubs and money remitters, have had their banking relationships either terminated or restricted. What then is the solution to de-risking? Regionally, countries must take the requisite steps to strengthen their AML-CFT frameworks to comply with the Financial Action Task Force standards. Similarly, steps must be taken to comply with FATCA and other international standards for taxation. In the medium to longer term, regional policymakers and regulators need to vigorously pursue collaborative implementation of Know Your Customer registries consisting of harmonized legal entity identifiers across the region. A KYC registry assists with AML-CFT since it provides a global source of high-quality qualified Know Your Customer information on correspondent banks that address the requirements of different regulatory regimes worldwide. Several high-level regional advocacy groups, including central bank governors, and these groups include Caribbean Group of Banking Supervisors, the Caribbean Association of Insurance Supervisors, and the Caribbean Financial Action Task Force, have been meeting with U.S. authorities to represent the region's interest on correspondent banking and de-risking at all levels. On the national front, Trinidad and Tobago has been taking steps to strengthen its national AML-CFT framework. As you may be aware, Trinidad and Tobago was the first Caribbean country to be assessed for compliance and effectiveness of its AML-CFT regime against the revised 40 FATF standards. The on-site evaluation took place in January 2015 and was conducted by 5 assessors who are members of the Caribbean Financial Action Task Force, known as CFATF. The report of findings was adopted at the November 2015 plenary meeting of the CFATF and has been published and was published on the website on June 3rd, 2016. In preparation for the mutual evaluation, Trinidad and Tobago, with the assistance of the World Bank, commenced a national risk assessment in March 2014 with a view to demonstrating compliance with Recommendation 1 of the FATF standards. In a nutshell, Recommendation 1 speaks to understanding the country's money laundering and terrorism financing risks and directing resources in a proportionate manner to address these risks. This risk-based approach is a fundamental cornerstone of the FATF recommendations. The conduct of the NRA has taken longer than was originally anticipated, but the process is nearly complete. A draft report has been developed, and in May of this year, the final workshop to agree the action plan was convened jointly by the National AML-CFT Committee and the World Bank. It is expected that when finalized, the findings will be used to refine the country's AML-CFT framework by ensuring that resources are appropriately channeled to areas of greatest risk. So why do we care about the mutual evaluation? Efforts to combat money laundering and curb illicit financial flows are a necessary step to protect the integrity of the financial system and improve security both at home and abroad. The mutual evaluation process assists countries in identifying the gaps in the AML-CFT regime and through peer pressure provides a strong inducement to countries to implement policy and operational measures to remedy those gaps. Not taking action can lead to countries being blacklisted and or losing access to the international financial system through loss of correspondent banking relationships, as indicated earlier. Negative mutual evaluations can also influence our international credit ratings and by extension our bilateral and multilateral trade agreements due to a loss of confidence in the integrity of our financial system. So then how did Trinidad and Tobago rate? As I mentioned previously, the report is now publicly available, so I will just give you very broad highlights. The assessment concluded that Trinidad and Tobago has established a relatively sound framework towards effectively preventing and combating money laundering and terrorism financing. However, deficiencies remain with the effectiveness of the regime, and a number of actions were recommended, including the strengthening of the AML-CFT framework to treat effectively with inter alia private members clubs, credit unions, non-profit organizations, terrorism and proliferation financing, and instituting a more effective and proportionate sanctions regime for AML-CFT non-compliance. As a consequence, the country remains in enhanced follow-up status, meaning that we have to report to the CFATF on our progress to address deficiencies on a frequent basis, with the first report due in May 2017. Consequently, going forward, the National AML-CFT Committee, of which the Central Bank is a member, will be giving priority to developing an action plan to address the priority actions and other deficiencies identified in the mutual evaluation report. This will include completion of the NRA and amendment or enactment of laws or policies to treat with identified deficiencies. Meanwhile, the Central Bank is in the process of revising its AML-CFT guideline to provide more sector-specific and risk-based guidance to regulated entities. It is expected that the guidelines would lend to the introduction of more pragmatic and risk-based KYC, know your customer, and customer due diligence information requirements at financial institutions. Emphasis has also been placed on developing better AML-CFT data and statistics to inform national and institutional policies and demonstrate effectiveness. As mentioned earlier, another international regulatory initiative with potential to impact correspondent banking relationships and de-risking is the Foreign Account Tax Compliance Act, known as FATCA, which became effective July 1st, 2014. It was enacted to combat offshore tax evasion with U.S. persons with accounts and/or investments with both foreign financial and non-financial entities. FATCA places a requirement on foreign financial institutions to identify and report to the U.S. Internal Revenue Service on the accounts of its U.S. clients with foreign financial assets with an aggregate value of at least $50,000 US. A U.S. person under FATCA refers to a citizen or resident of the United States or a U.S. partnership or corporation, including those residing outside of the United States. The financial institutions in Trinidad and Tobago which will be most impacted by FATCA include banks and non-banks, brokerage firms, and insurance companies. Entities and products deemed non-reporting financial institutions and products under FATCA are generally exempt from FATCA reporting. However, there may still be FATCA-related requirements from the financial entities with which they do business. In Trinidad and Tobago, credit unions, for example, may fall into this category. A list of financial institutions and products that are generally exempt from FATCA reporting because they represent a low risk of tax evasion for U.S. persons include government entities, international organizations, central banks, and certain retirement funds, to name a few. When non-compliance with FATCA is determined, a financial institution and U.S. persons will be subject to a withholding tax of 30% to be applied on all U.S.-sourced income. Trinidad and Tobago may also be perceived as a non-cooperative country, aiding in the perpetration of tax evasion and money laundering. This may negatively impact correspondent banking relationships as well as diplomatic relationships with the U.S. This is where non-compliance is determined. In terms of implementing FATCA, intergovernmental agreements known as IGAs have been developed by the U.S. to assist in FATCA implementation in foreign jurisdictions such as ours. The IGA is designed to address legal impediments to compliance and simplify practical implementation. Most requirements in respect of FATCA compliance are detailed in the IGA. Trinidad and Tobago has opted to adopt a FATCA Model 1 IGA, which in brief means that financial institutions in Trinidad and Tobago, instead of reporting directly to the U.S. IRS, will report FATCA-related information to the competent authority, which is our Ministry of Finance, and the reporting will go to the Board of Inland Revenue, which will in turn report to the IRS. A draft bill has been prepared by the Ministry of Finance to effect the IGA. The bill also proposes to amend other legislation to facilitate FATCA, and those legislation include the Financial Institutions Act and the Insurance Act to address confidentiality issues. Some of the conflicts that the proposed legislation seek to address include the ability of financial institutions to disclose customer information and data protection laws which require consent of a person to disseminate their financial information. Compliance with FATCA requires financial institutions to have new or extended information systems in place to enable them to fulfill their reporting requirements. It is also necessary for frontline staff as well as operational staff to be trained so that they are aware and understand the requirements of FATCA. So where are we now? The clock is ticking on FATCA, as the deadline for transmission of data to the IRS is September 30th, 2016. Given the potential impact on our financial institutions and the country as a whole, it is imperative that we keep the impending deadline in mind and ensure that all necessary legislative and institutional requirements are in place. Immediate next steps involve signing of the IGA by the Ministry of Finance, enactment of the FATCA implementing legislation, and transmission of the data to the IRS by the deadline of September 30th, 2016. Finally, there is a need to raise public awareness on the pending implementation of FATCA And forums such as these are perfect avenues to do just that. I thank you for your kind attention, and I will now hand you over to the Governor, who will take you through institutional reforms and the payment systems. Thank you.
Thank you very much, Michelle. Welcome, colleagues. Thanks for taking the time to be with us. I see a lot of important people here, including the front table and all around. Yeah, I know it's a lot of money you have to be foregoing to be here, so welcome. This is the second part of our mandate. A couple weeks ago, we focused on the monetary policy side, the central bank's mandate. And the other aspect is on the financial stability side. So this is what we are trying to explain what we are doing, to take questions, and to constantly improve how we are performing our functions. We have prepared the financial stability report. Some of you would have got it, the media and embargoed version, but it will be on the website, as well as the PowerPoint presentation by 11:30 this morning. And those of you who are here, you could grab a hard copy on your way out. Now the team of Michelle and Michelle have done such a fantastic job that I don't really have that much to do. So, but let me seize the opportunity to focus on two aspects. One is on insurance reform, one is on the payment system, and then I will just wrap up and try to put in context all of what we've been doing. So insurance reform, why am I focusing on this? One of the major gaps in our legislative framework for supervision and understanding and monitoring and controlling the activities of the financial system is on the insurance side. We have a very outdated act. It's 1980, and it's fundamentally unchanged from an earlier act, which is 1966. What are some of the major things that are not included and that should be included in this modern world? The first thing is that it does not require insurance companies to hold capital commensurate with their risk profiles. What does that mean? As it is now, the longer-term insurance companies are only required to hold $3 million in capital. I'm sure some of you have that in your pockets right now. And the general insurance companies, $1 million. In these days of billions of dollars rolling around the place, this is completely inadequate, but this is what the law requires. And more so, in a context where risk is involved, there should be some capital that is put commensurate with the risk of the activities. But the current act does not provide for that. Some corporate governance requirements are not very well put forward. What do I mean? Corporate governance is important in terms of how an organization conducts itself, the ethics, the legal framework that it adheres to, the principles of integrity and so forth. And the legislation currently does not give very minimum standards on that. And to be fair, there has been a lot of development in this area over time, and we would know of our corporate governance code that has been enacted. I think it is in 2013 to shore up the performance and the approach to governance of local institutions. So we are way behind the curve in that area in the existing legislation. Consolidated supervision, it does not give much on that. And we know we have groups that are not just insurance groups, but they may be bundled with other financial institutions and also non-financial entities. But the current legislation does not give scope for that. Similarly, the oversight of financial groups, there's not enough on that per se. But there has been a process of reform, and it has been quite a long time, over 15 years. So the reform process began way back in 2001, and even before that, I would imagine. And there were some insurance bills laid in Parliament in 2011, 2013, 2015. But as we will realize, it has not borne fruit yet. So this is what we need to have it crystallized and passed and so forth. In terms of specific amendments to the Insurance Act, we had some enacted in 2009 to treat with the sharing of information, sufficiency of assets in the statutory fund, etc., and a few other things. But still, a more fundamental reform has not been done yet. Let me turn to some of the key provisions of the insurance bill that is currently being that has been put forward in 2015. Now, I must admit that some of these things are still in a state of flux. I see people from the insurance sector here, and they would have some views on these things, but at least it's a major start. It had gone before a joint select committee and so forth, so it is an excellent framework to continue the discussions and to get things sorted out. So, what are some of the things that are involved in this? It would provide a new regulatory framework for insurance companies and the regulation of privately administered pension plans. Some of the main areas: prudential regulation and financial soundness of insurance. That should be significantly enhanced. Minimum capital requirements would be introduced. It would go from 3 to 15 at least. But it would also be, the second point, risk-based capital, so that to the extent that risky activities are involved, the capital could actually be increased. A consistent minimum basis for the valuation of liabilities. As it is now, the valuation could be on different bases. It's not common, and the actuaries, they have sleepless nights over this. We have Neil here, we have Michelle here. They always complain about that, so we want to keep them happy. A stress testing regime. Michelle 1 had talked about the stress test for the commercial banks, where you look at plausible and extreme shocks, and let's say to interest rates, to the exchange rate, to whatever, and say, well, what would happen in those cases? For insurance companies, you need to do the same thing also, because let's say you have something is happening in the economy or something is happening with interest rate. You say, well, what would the balance sheet look like? In the stress testing framework for the insurance companies actually much more advanced in the proposal, and that they would be doing it via what you call financial condition reports. So that is something that I think would be quite essential. More prudent limits for credit exposures to connected parties. This is important because insurance companies do expose themselves to credit facilities, in the sense that they would lend to different companies, businesses, individuals, and whatever. And to the extent that a lot of this is going to specific individuals or there's a lot of concentration, you could find a lot of fragility in that area. So again, the new insurance bill, which would hopefully be getting into an act shortly, would deal with some of these things. The corporate governance idea, this is quite important. Some of the areas would be mandatory audit committees of the board, because in your institutions you need to have a separate audit committee to be able to look very carefully at the finances, the risk, and so forth of the institution, and to drill down into it. There would also be stipulations as to the criteria for being a chairman of the board. You can't be just anyone. You have to be someone who holds a certain amount of experience and qualifications to be able to do the job properly. The appointment of independent directors, this is related to that. The adequacy of internal controls, that's quite important, because if you don't have internal controls that are very robust, then things could easily go haywire, because you don't want to wait until the regulator comes in to tell you something is going on. You need to have internal controls, then you have the audit committee, you have the board, and so forth. So different ways, different checks and balances to allow things to run smoothly. And then the regulator could come in and maybe help on the margin, but it should not be the first resort. The approval of interlocking directorships outside of the financial group, I think this is in the bill, but it may still be somewhat controversial, but the idea is that to the extent that you have directors that are on different financial institutions and different bodies, then it is important to look at the whole picture, not just a part of it. So this is where this comes in. Enhancing the supervision of insurance groups. One of the main things that I suggested is that the present legislation does not look at insurers on a consolidated basis. So the new legislation is intended to look at things on a conglomerate basis and to allow the supervisor to have a holistic view of an activity. Because as we know, if you have different entities in a group, you could have transfer pricing. One is, lending to each other and so forth, and things could get muddled up in the all of them being together. So this would allow the regulator to have a panoramic view and authority to be able to interrogate the financials, to interrogate the directors, to interrogate everything, and to understand things in a better way. Similarly, the second point, information from unregulated non-financial entities, because you would have situations where you have financial entities, let's say insurance companies, non-banks, banks, but it may be bundled with a firm that is selling, I don't know, sweet bread or something. Maybe not sweet bread, but something else. And so you want to have the non-financial entities also being part of the supervision, depending on the severity or the particular case. It won't be an ongoing thing, but to the extent that it is necessary and red flags are raised, then the regulator could go in and say, well, what's happening here? Cross-border supervision of insurance subsidiaries and banks also. As was suggested before, we live in a global world. We have a lot of interlocking and interconnectedness within Trinidad and Tobago, but also across the region. The financial institutions have their hands in different pies within the region, and not only in the region, in Latin America, in Africa, in North America, and so forth. So you need to have something to look at supervision across entities. So this would allow for cross-border supervision. And related to that, the establishment of financial holding companies would be allowed, where the central bank could say, all right, you have all of these entities, put the financial institutions in one bag, as it were, and call it a financial holding company. And this would be easier to monitor and look at. So, just to summarize on this insurance legislative reform, where are we? So the reform process began in 2001, as I was suggesting, and in 2004 the central bank was appointed to be supervisor of the insurance companies, but with still an outdated legislation. And subsequent to that, there have been some moves, amendments to the current legislation made in February 2009, and there were also a bunch of small changes. More recently, we have a joint select committee, as I said before, appointed by Parliament in 2013, reviewed the bill was revised and so forth, and it has been going back and forth, but with the dissolution of Parliament, I think there has been some slowing down of activity. The bill is on the short-term legislative agenda of the government, but we are taking this opportunity to not so subtly lobby for urgent attention in this area, given the importance of it. So this is on the insurance side. Let me go on to a few issues on the national payments system. Now, first of all, people may not know what the payment system is, and to some extent, this is good, because it's like the heart. If something is, you only realize it if something is going wrong. But we have all these financial entities, and how are they connected? How do they get blood? How do they interact with each other? It's through the payment system, where you can settle your financial transactions from one to the other either domestically or internationally. So it is very important, and it is the heart of the financial system. And as I said, it's only when something goes wrong you might say well, okay, the heart is important, but before that you say, well, I'm playing football, I use my feet, I'm playing cricket, I use my hands, I'm singing, I use my voice, but let the heart go, get some problems. You can't do any of those. So this is what the payment system is in a crude nutshell, as it were. But what are some of the reforms that have been taking place? We've had some major reforms since 2002, enhancing the infrastructure and moving towards a more electronic form of settlements and payments and so forth, instead of cash and checks and so forth. But as I said, most of you would not know what these things are, and because it's just in the background quietly. But some of them include what we call the real-time gross settlement system in 2004, where the commercial banks and the central banks settle large transactions over 500,000 among them in fairly real time. The government securities settlement system in 2004, which deals mainly with government transaction, and the automated clearinghouse since 2006, which deals with more with smaller than $500,000 transactions for the most part, and so that if a company is paying its staff, for a lot of times they would not send a check to the bank, but they may have it through what they call the ACH, and then payments are made from that. Some of the other reforms include strengthening the legislative framework to enable supervision and oversight of the domestic payment system, the institutionalization of the payment system oversight function at the central bank. So we have a payments department, and recently it was merged into the financial stability function because it is very much connected, and they are very vocal, they're very active, and they are because it affects everything, our research, our statistics, our financial stability, and so forth. So we are paying a lot of attention to that. And we've had, again, quietly in the background, the establishment of a payment system council since 2002, which is really a group that meets under the chairmanship of the central bank, and is comprised of members of TAT, of the Charters Accountants, the Ministry of Finance, iGov, TT, the commercial banks, Chamber of Commerce, and others, to look at payment systems issues in Trinidad and Tobago. And they have been working very quietly in the background, and a lot of the reforms have come out of that. So just to give a very short flavor of the payment system in terms of the transactions, the top looks at the volume of transactions, and you'll see we put some of the major forms of payments modalities, as it were. So you have checks, you have debit cards, links and so forth. You have credit cards, you have the ACH, which I mentioned before, and you have the RTGS. The first one looks at the volume, meaning that how many people use it. And you see it's a lot. This is in thousands, so it's 5 million, 10 million, etc., etc. If you look at the bars themselves, what stands out is that, well, checks and credit cards are neck and neck, but credit cards have gone up over time. We have the debit cards, the links has been rising steadily from 2010 onwards. And you see the automatic clearinghouse, the last bar that you could discern there for the most part, has been also increasing over time. The real-time gross settlements, you could hardly see it. You had to have a microscope to see it. So you see the numbers look small, but they could be misleading, as you see, see below, because one transaction that qualifies for RTGS is large, right? So that when we look below now, you see the value, you see the difference in the value, because the checks are still relatively high, but when you look at debit cards and credit cards and ACH transactions, they are much lower, and the RTGS is quite large. So this gives an example of what is happening here. So you use your Links card. A lot of people use that. They use their credit cards. But in terms of the overall volume that is passing through the payments, the overall value, it does not turn out to be that much. It doesn't mean it isn't important, but it doesn't turn out to be that much. So this is what we have to be taking into account when we look at things. And one of the things that we are trying to encourage, and the payment system council people are very active in that, is in this modern world to be moving away from checks and cash as far as possible to electronic forms of payment. But as you would know, there are issues that people would necessarily want to take into account. Is it safe? Is it reliable? Can I use it legally? And do I have a record of it? You know, you give a check, you say, well, okay, I could photocopy the check, I could make sure you sign, and, you know, you have a record. If I do it electronically, has it happened, and so forth. So those are the things that need to be taken into account as we move more electronically. But certainly, this is the way of the modern world, and the way that financial transactions would be moving much more quickly. So just that gives an introduction to the payment system in the modern world, and why do we need to take this into account? Some of the things, the rapid pace of innovation and technology globally, new payments products. We know there are a lot of things coming up. You have PayPal, you have this, you have all number of things that are emerging as we speak. Novel processing methods, new players such as non-banks. We have a lot of things globally in Africa. You have a lot of mobile stuff where people, you know, they don't have a bank account at all, and they just use this. So we have to be aware of these kind of things, because they will impact us at some point in time. The greater demands of the new international best practice standards. What do I mean? It is recognized globally that the payment system is quite important. So you have, I think as was stated before, I think in a couple months ago, we hosted a payment system conference in Trinidad and Tobago, where people from Latin America and the Caribbean and even North America came. So there's a lot of activity on that. All the central banks are in this network. And so given the importance of it, there have been a lot of international standards that have been put forward to strengthen the efficiency, the effectiveness, the governance, and the safety of this infrastructure. So they are bundled into what they call 24 principles. In 2012, I think it was that they were launched. We have been, in 2014, we've started to work towards this, because the central bank has a supervisory role. So we look at the ACH, the RTGS, the links, and all those sort of things. And we do discuss with these operators how their systems are working. So some of the principles would be looking at credit, liquidity, settlement, safety, governance, and so forth. So these are the principles that we are adhering to, and that we're trying to promote to make a sound and better payment system. The e-government agenda, I'll just give a little blurb on that afterwards. But what it is, a couple of years ago, it was not legal to be able to pay the government by credit card and so forth. There has been some movement in that regard, and as I'll discuss in the next slide, it is now, you can legally do it, but some of the infrastructure work still needs to take place. And why is this important? Because, again, if the government is raising taxes or dealing with people on a regular basis, you don't want to have to be walking around with loads of cash, because it could be a real safety issue in this day. And to be using checks could also be somewhat cumbersome. So this is where the e-government agenda is important. And then similarly, business and consumer demands for more efficient payments services, either domestically, internationally. We are linked with everybody else, so we have to step up. Otherwise, we will be, put into the background. So in this regard, straight-through processing of electronic payments, meaning that they would be seamless. They would not have to go through, the front hoops to do that. Faster, reliable, and transparent services. So efficiency is the order of the day. You want something done, you could do it very quickly. And effective reconciliation of transactions to make sure that what I say I pay, you say you acknowledge you receive. Otherwise, it could be chaotic. So the last point I want to make on this is, as I was saying, the government's e-payment initiative as one example, because we could spend all day talking about payment system, but I just wanted to use this as one example, that the bank has been working with the government and the Payments Council to advance work in this area. And there have been, as I suggested before, not in the not too distant past, you could not legally pay to the government using credit cards and so forth. It just was not part of the law, but there have been amendments to the Exchequer and Audit Act in 2014 and some regulations thereafter. But there's still work to be done, in particular operationalizing this, getting the infrastructure, the communications infrastructure and so forth to sort it out so that you'd be able to have payments being made smoothly, because, governments are large. They form a big apparatus, and you have different local governments, you have Tobago, you have ministries and so forth. They not all need to be integrated, and then the accounting for them needs to be sorted out so you could pay salaries, vendors could do their transactions with the government, and you could also get your receipts for taxes and so forth. So work is ongoing in that regard, and we hope this would be advanced quite quickly. So those are the two issues I wanted to just to chat about. And what I want to do now is to sort of wrap up by giving the key messages that we think we would want to leave you with from this presentation on our report. And I'm sure we'll have some discussion later on today, but certainly feel free to communicate with us over time as to whether things in the report are mysterious, understandable, or you don't agree with it. So what are the key messages that we would like to say? First of all, in our view, the financial system in Trinidad and Tobago is sound and resilient. We looked at the data, we looked at the information. We have, in our best judgment and analysis, this is what our summary of the situation currently in our country. By most metrics, as I said, the data we look at, and Michelle had gone through in detail some of these things. Financial institutions remain well capitalized, liquid, profitable, with relatively low incidence of non-performing loans. This is in general. You may have differences across institutions, but this is the big picture that we want to convey in our view. But however, we cannot be complacent. In the last presentation, as I said, on the first aspect of our mandate on the monetary policy side, we did caution that we are in a difficult economic situation. We have a shock that is with us now. It's not coming, it's here. And there are implications of that for the government, for the balance of payments, for the reserves, for businesses, either in the short term or the long term, and clearly for the consumers, and necessarily for the financial sector. So the financial sector is not immune. But given that we've seen that our system has some resilience, this is encouraging, but we cannot be unaware of it. So how could this manifest itself? One way is through credit quality, and we want to be. We have been talking to the banks very much on credit quality, looking at it, and we've been having special examinations to work with the institutions to understand this and to shore up that aspect, because to the extent that whoever the creditors, or the debtors, that is, I should say, have a lower income, their debt servicing capacity could be compromised, and this would be reflected in credit quality. But as the figure showed, so far overall the non-performing loans are quite moderate by any standard, but we can't be complacent. We have to look at that, and we have to look at it in particularly vulnerable sectors, that's starting with the energy sector and so forth. So it is a comprehensive plan to focus on that. And care must also be taken to avoid undue asset concentration. In other words, putting your eggs in one basket, because if you have certain sectors or certain activities that could be in for a rough ride, and you focus on that, then I'm talking about the commercial banks or the financial institution, focus the assets on that, then it could be even more risky. Another point is that the high degree of interconnectedness of financial institutions across and conglomerates across the region demands close collaboration among regional regulators, because as we discussed before, commercial banks, insurance companies, non-banks, conglomerates have their, and I think this is a good thing, have their activities not only in Trinidad and Tobago, a lot of them, because of economies of scale and so forth, you want to branch out and so forth. This has two sides to it. One is that you could be more vulnerable to something happening in another country, but it also could be a diversification of your own risk. So, however you cut it, this is the situation, and it goes both ways. For example, we have Trinidad and Tobago companies here investing in Jamaica. We have Jamaican companies investing in Trinidad and Tobago on the financial side. So we have to have close collaboration among regulators. Just recently, there was a meeting of the Caribbean group of banking supervisors discussing that last week. I was at the meeting of CARICOM Central Bank governors in Jamaica, and we discussed a lot of those things. So it really requires close and intense collaboration among regulators. There are what you call regulatory colleges, where the regulators from different central banks would come together and discuss common firms and common financial institutions, so that you understand that. So I think this is a quite important point, and a lot of work has been is going on in that area, and perhaps at some other time we could explain some of the developments in that scenario. The last few points I'd like to make is related to the other things about de-risking, as we talked about before, that this refers to a situation where commercial banks, international commercial banks, or other entities may shy away from a particular activity, region, or institution, smaller institutions, because they say, well, it's there could be a lot of risk involved in it. And plus, their regulators may be on their backs and say, well, why are you involving yourself with these institutions in another jurisdiction that may not have proper anti-money laundering guidelines, know your customer processes. They may be conduits for financing terrorism. We saw what happened with the Panama Papers and so forth. So with all of that now, we could find, and the Caribbean countries are very concerned about particular instances. In our case, we do have two things that are on the immediate agenda: the anti-money laundering and combating the financing of terrorism standards that we want to shore up, and the financial, the foreign, let's go, FATCA. I can never remember the acronym. FATCA. But anyway, we know what FATCA is. Right. In the context of our global financial interactions. So we need to get our act together. A lot of it may not be technically difficult, but it needs coordination and concerted effort and focus. The second and last point that I made on the insurance sector, we need to make sure that that we beef up our legislation on this front. I'm sure there would be it may take some time to finalize once you have another round of discussion, but we need to get it moving and sorted out. And finally, the concerted and coordinated efforts made to bolster the security and efficiency of the payment system in this modern world, including completing the steps for government electronic transactions. So with that, I'll just wrap up and we'll take a few questions. Thank you.
Thank you, Governor. Michelle and Michelle. And no, your name doesn't have to be Michelle to be part of the bank. I just want to remind you of the ground rules. You walk up to the microphone. If you say your name and your organization, that's helpful. And we really, really do value the opportunity to interact with you. So don't be shy. Come forward.
Good morning, Nigel Romano from JMMB Bank. Governor and Michelle and Nicole, I just want to thank you all for an excellent presentation. And I think I speak on behalf of my colleagues in the banking sector. And we appreciate the push for FATCA, AML, and the whole de-risking conversation, because it definitely affects some of us more than others. And we are very appreciative of that. I also welcome the electronic payments focus, because I think as banks, we can really benefit from more transactions going electronic than people having to line up and withdraw cash from banks or to work with checks. So I just want to thank you all. Fantastic presentation. Take care.
Good morning, Wayne Das. I'm Carrie Chris. I just have a question as regards operational risk. In terms of, as part of the Basel II implementation that you're doing, I just wanted to find out if implementation of operational risk is going to be part of the Basel II rollout. And I asked that because of, with the rapid advancement in technology and so on, cybercrime and cyber risk is actually a major risk now worldwide, and there's no reason why the financial institutions in Trinidad and Tobago can't also be impacted by that. So, and that as a subset of operational risk, I think needs to be paid attention to.
Hi, good morning. Ian Chinoku from Unit Trust. Noting the looming deadline for FATCA reporting, I think the elephant in the room is around when will the BIR be ready to receive our reports and in what form. So that's the big one for all of us, I think, given the impact on the sector and the potential withholding of our U.S. income. Do we need to close down our U.S. funds and so on? Thank you.
With respect to operational risk under Basel II, it will include a capital charge for operational risk. We are planning to go with a standardized approach, meaning that once you divide your business along different business lines, there is a factor to be applied depending on the business line. And that's the approach we are going with. Internationally, the models-based approach is being relooked, and the Basel Committee is really shying away from the models-based approach. Right, so, and I do appreciate your issue with cyber risk and cybercrime. It is occupying the central bank's attention, and it will be one of our areas of focus in terms of on-site evaluations going forward. With respect to the deadline for FATCA approaching, I do not know a precise time in terms of when the BIR will be ready to receive reports, but the central bank is continuing to liaise with the Ministry of Finance, and actually there's going to be a meeting shortly to discuss where we are and how we progress with FATCA implementation.
The thing that attracted my attention is the focus the precarious position, I don't know if that word is too strong, of the housing debt sector. People have grown accustomed to a certain standard of living, 2 cars, 3 cars in the garage, big mortgage to pay. I think the figure I saw is 60% in the document of the outstanding charges. How do you get people to back off from that kind of lifestyle? In fact, they were expecting to go further. How do you get them to back off from that? I know the last time you recommended Rio, and I had to listen to him again yesterday. Rio. Back to basics. Yeah, but you still have to make up your mind how you do the thing. And then, of course, the banking and commercial banking sector. If there is some breakout of that situation, how it will impact, and how bankers, I think you mentioned quality credit, how are bankers to operate in this new environment? And remember, we are talking about a sector which triggered 2008. So it is vital to our operations here. I just want to hear your thoughts on that.
Essentially, as we said, we are, as a central bank, working with the bankers because we engage with the institutions, our examiners on a regular basis. We do on-site examinations, we go in quarterly, and we really work very closely with the bankers in understanding what they're doing in terms of managing their credit risk and so on. As I said in the presentation, the underwriting standards have been robust in our view. I mean, obviously there will be 1 or 2 banks that would be a little bit outside of the norm, but in looking at financial stability and overall, we don't think that this right now that would have the kind of impact because of the strong capital position that these banks are in. As you saw, the NPL ratios have come down. Certain banks went through some issues some years ago with real estate, yes, but that would have been commercial real estate and not the kind of stresses we're thinking about in this environment, which would be the household debt. So we think that they're resilient, and as we said, we'll be monitoring and so on. I'll leave the governor to talk a little bit about his views about how do we change lifestyle in this country. It's probably a philosophical.
Thank you for that. No, I don't think it's necessarily changing lifestyle, but credit. There's nothing wrong with credit because people, when you have a certain income and you need to buy a large item, you would not have the resources. What you need to make sure is that you have the wherewithal over time to be able to service that item, like a mortgage or a car or some sort of thing, and that it provides the necessary service to you. So in my view, it is better for you to purchase a house that would last for generations than, let's say, a vehicle that may look flashy, but it lasts for a short period of time unless you have the wherewithal to do so. So if I were to extend from Rio's thing, I think it's important for people to be able to look at their debt servicing capacity and see whether this has been compromised at all. So in terms of new borrowing, you don't want to get to over-leverage yourself in this environment. I think in the case of the commercial banks, they have been, one of the things that distinguish us from the case of the US and in the subprime crisis which you're referring to is the conservatism of our financial institutions, which I think has served them well in that regard, in the sense of, if you look at what you have to do to get a mortgage loan now, I think it's still very much the case. The loan-to-value ratios tend to be very conservative. Then you have to have insurance, and you cannot borrow it and pay it after 60 and all this sort of thing. So with all of that, those constraints, it provides a lot of controls for not defaulting. Now, I think that conservatism, I think, has served well. What I suspect has happened over the last few years is that because of the high liquidity situation, the commercial banks said, well, let's get into an unexploited area. And the unexploited area, I suspect, would have been the equity that people may have had in their homes that were not being utilized. Now, in the U.S., you have a house, those of you who watch HGTV or whatever, and you say, they say, well, my house is now worth $400,000, and the people are excited because now they could get, $100,000 loan extra to what they had before because they cash in on the equity quickly. In the case of Trinidad and Tobago, that is not the case at all. But I think the commercial banks and the individuals may have been tapping into that, so you may have had some more equity loans. And then in a situation where, what are the options? You may have some consumer durables, you may not have had, interest rates are low. So the push was to bump up the mortgage activity. But we have noticed that this has tended to taper off over the last few months in particular, over a year and a half, I would say. So it's about 8% growth. It's not that much more. So, but I do take your point that over-leveraging could be a problem for individuals, so this needs to be taken into account. For the commercial banks, they have to be very aware. And I think as Michelle said, a lot of the problems in the housing or the mortgage market had tended to be on the commercial side and the high-end housing for rent and so forth. That really took a beating, and I think that may be very vulnerable now. So I would hope that people would learn from what has happened before. I remember at a time in, I think it was the 70s, and you had something called Varenstall, yes, where banks would give you loans, and you would say, well, your debt service would rise, and they would build that in your variable installment. It would go up $100, $200, $300, because you anticipate that your income would rise continuously. And guess what? It didn't. So then you had that problem. I think there has been some learning from that situation, so we don't have that happening now. But generally, yes, over-leveraging is something you need to be careful about.
Good morning, Darabite. Just firstly, again, to extend congratulations on an excellent presentation, but also to inform the conversation around banks in 2008 and an attendant question with that. Firstly, to inform that conversation, we want to point out that, and by the way, of course, I am president of the Bankers Association, so putting that hat on when I'm speaking as well. In 2008, interestingly enough, I think people need to be able to differentiate between what happened in the USA and what happened here. It was among investment banks more than anything else. They were undercapitalized. They had a lot of extremely complicated type products and levels that market was yes, it was a connected scenario, but the interesting thing is that our financial services system was extremely resilient throughout that. And I think when one compares it, that is actually what helped us through that entire period, the conservatism and the prudent approach of banks in Trinidad and Tobago. That's the first point I'd want to make. The attendant point to that is that, and which will lead to my question, is that other or should I say less regulated sectors of the financial services industry are the ones that in fact were affected in 2008, whether it might be in the insurance or in the credit union sector. And the questions really, I think the banks have had their upheavals, one it would have been in the 80s, but since then, and all of the statistics shows increasing regulation of banks, adopting Basel II standards, the metrics are in place that give you all the measures. So it's clear from the information that you've presented that everything that one could reasonably expect to be done in terms of regulation of banks is being done. Even when you talk about things like the minimum the mortgage rate, the mortgage market reference rate and the like, which again is a measure to ensure that there's spreads on mortgages and there's a control in terms of where the spreads go on mortgages. So even as people are concerned about mortgages and people meeting their mortgage commitments, there's a control in place that was not there before. So the question that I would have really is how and where is regulation and outside and the broader financial services industry headed, given that we are where we are today, and when we look at the state of the economy in Trinidad and Tobago? Because I think those are some of the, because in the more recent past, most of the upheavals, and I know you've spoken to the insurance services industry, but more of the upheavals have come from those areas than have actually come from commercial banks.
James Camacho, I think just a quick question. Any idea when the insurance bill will come back to Parliament?
Yeah, to both gentlemen, I guess what you're asking is you're endorsing the governor's not so subtle call for a little bit more priority on the insurance bill. We intend to engage with ATIC very shortly because we did get a letter from you asking about certain things that were a little bit open-ended maybe in your eyes when the bill was laid in Parliament. So we will be doing that. And then we will be working with the ministry to try to press for it to be laid sooner rather than later.
Yeah, so we have a growing lobby, so hopefully it will be sooner rather than later. On the question of regulations, what you refer to is sometimes called regulatory arbitrage, where standards may be, to the extent that you have tight regulation in one area, then things slip in another area and people go there. You mentioned the credit unions. There had been some discussion on that. I'm not sure exactly where that is headed, and there are different views on it. So we'll try to influence as much as possible and make a contribution in that area, even if it does not come within the regulatory purview of the central bank. We will still be able to give our views as to how we think things could happen and how we could influence the dialogue. But things don't stand still meanwhile, and so what we would be urging the different sectors would be to shore up their corporate governance frameworks meanwhile anyway, and their standards, even in the absence of regulation by the central bank, or gaps in legislation or gaps in supervision and so forth, because you would have consumers, the shareholders, the directors, the people who borrow from these institutions should all have a voice as to how these conduct themselves, even in the absence of tight regulation. So the short answer is that I can't say when the insurance bill would come, but we are hoping for it to be high on the agenda. And in terms of the regulations of the others, we'd see how it evolves, but we are prepared to contribute in terms of our technical expertise and our experience in any state of the world.
If there are no more questions, I will just want to thank you. Thank you for coming. Please be safe on the roads and see you next time. God's richest blessings to you all. Thank you.